Hey everyone, what's up? Today I want to talk about how I think about investing my money as a freelancer. Obviously, nobody ever taught me that. They don't teach you that at design school or freelance school in general, and that caused me to make some serious mistakes along the way. And so I've invested a lot of time and effort to try to think about this and do this smartly. I want to share with you my thinking around this. Start with the story of, how I learned my hard lessons. And basically around 6 years ago when I got married, that was the first time when I actually had a bunch of money, more money that I had like cash on my hands, and I needed to do something with it because it's common knowledge that if you put it in a normal savings, you don't make any money. Actually, you're losing money because the interest rate is lower than the inflation. So actually, you're actually just losing money. So at that point, I was actually working at a startup company and everybody was talking about stocks and, I'm buying Amazon stocks, I'm buying Apple stocks, I'm buying this and that. And I was like, okay, let me check some stocks. So I went on Google and, started looking at some tech stocks. Why tech stocks? Because that's what I know. I work in tech. I follow some tech companies. I read tech news. So I was thinking about, hey, let's check that. And after looking at that, remember that was 6 years ago, what I saw was that Apple, it was an amazing company and it's making like, I don't know, 30 to 60, the stock goes up 30 to 60% every year. When I realized that, I was like, what the hell? How come nobody knows that? If you put like your money, you're making 30 to 60% per year. That's just crazy. How come nobody talks about this, and how come not everybody just puts all their money on Apple? So at that point, what I did was to take all of our wedding money, which was a lot, like all the gifts that we got during our wedding, and using all of it to buy Apple stocks. So that's what I did, and I was very optimistic, telling my wife, yeah, we're soon going to make a lot of money and everything. And the minute that I bought them, like 2 days after, Apple stock started to crash. And that was, again, 6 years ago. I don't remember what year it was, but their stock, in like the span of 3 months, the stock lost 30% of its value. And it looked like, and I was very nervous, obviously lost 30% of a lot of money in a very short time of period. I was like every morning, every hour checking the stocks, reading all the Apple news and whether it's going to go up, going to go down. This was very, very stressful. And at the end of it, after reaching a certain point which was just too painful, I just sold everything and I was like, hell, I'm not gonna lose any more money on the Apple stock. And it did go lower after that. And it was funny, I lost so much money that my wife told me, hey, you could just paid for a degree in finance in three months because you actually paid this and you learned how to invest, or more importantly, how not to invest. And the first lesson of that was you never, never, never put all your eggs in one basket. And the second thing was you can never time the market, or you can never pick a stock long term enough. Obviously I made every possible mistake because in the long term enough, now 6 years later, the stock price went down and then started to go up. And if I didn't sell, if I wouldn't sell, I would probably double my money. But the point is that we are very emotional creatures, and if you don't have a framework for thinking about investment, you're going to make stupid emotional mistakes. And after that happened to me, I really started to take investment seriously and started to read a lot of books. And there are two books that really influence the way I think and the way that I kind of manage my investments today, and I want to share them with you. So the first one is called The Intelligent Investor, and that's the investment book that Warren Buffett is recommending, or that's his favorite book about investing, and I recently read it. Basically, I'll sum it up for you really quickly. You can either be an active investment, which means that you are very, very focused on winning the market, or you can be a passive investor. And passive investor means you don't try to win the market and you acknowledge that you're not smart enough or you don't have the resources to try to win at the whole of Wall Street and a gazillion million smart people whose sole job is to win the market, and you just sit at home and think, oh, because I read the news every once in a while, I can pick the right stocks. And just understanding this framework got me to understand that, yeah, it's not going to be my whole life trying to win the market at investment and stock investment and stuff like that. I want to be a designer. I want to be a freelancer. I want to, run my own business, work on my own product. So investment is just, it needs to be on autopilot. And so that puts me in the passive investor category. And that means that I have to be rational and understand that I'm going to have normal average market returns, which is over the long term is very good, but you can't be too greedy. And the fact that you try to think that you can do it, that kind of greedy mindset is what usually makes most people make mistakes, and that's where everybody falls, on thinking they can be smarter. And you have to put down your ego, understand that you're not going to be smarter. And by being passive investor, that's not very, it's pretty boring. It's just picking, like betting on the whole market with index funds, which are like S&P's 500, which is just like buying the whole market. And usually the whole market goes up on a long enough term. So you split your investment in like 50% the stock market, again on like the largest companies, S&P 500, and government bonds. That's kind of like the basic premise of the book for passive investors. Active investors, that's something completely different, but I'm not going to go into that. So that's kind of the first thing. The second book is Rich Dad, Poor Dad, which I know it's is kind of controversial, but I think a lot of people don't understand the point, or what I learned from this book, which is a lot of people think that the point is, yeah, you have to invest, you have to let your money work for you. And the guy in the book talks a lot about real estate, so maybe real estate is a good investment. But what I took from the book is that you make better investments if you can influence the investment to make sure that they go in the right direction. Because what happens when you buy a stock in the stock market, I bought a stock of Apple, but that doesn't mean now I don't have any influence about what happens with my money and my investment, because I don't have influence over Apple or whatever. And that's different from Warren Buffett, because when he buys big chunks, he gets a seat on the board and he can actually influence his investment. So we are very, very different in our what we can do with our investment. And the guy in the Rich Dad Poor Dad book, he says, I'm buying real estate. Why? Because I can then influence the real estate that I buy. I can renovate it. I can make it look better. I can sell it for a higher price. So I can actually influence it. And so a lot of people read this and I was like, okay, I'll go to invest in real estate because then I can control my investment. But what I understood is I'm not going to go into real estate for the same reason that I'm not going to win at stock, because real estate is not my life. There are a lot of people who are very, very professional at doing this, and getting the best deals and super efficient with renovating. And if I'm just doing this as a side investment type of thing, I'm never going to win at that. So I just gave that up, and I understood what he says is that the best way to influence your investment is start a business, because if you have a business, you really own it, you really control it, and that's going to end up as being your best investment. And that, I think, is key, because for me, I'm a freelancer, and so my business is me. And actually the best investment that I can do in my business is to invest in me. And so for the past few years, I've been investing a lot of money, and that just went into books, online education, courses, programs, conventions, doing stuff. This year alone, which is the year that I have the most tremendous growth in my income, but also in the amount of investment that I make in myself, which is the business. So I think I'm gonna, by the end of the year, I'm gonna pay $15,000 in coaching and over $5,000 in online courses and programs and books. I don't even count how many books I read, but the major and the biggest investment that I make is in myself, because the more I invest in that, the higher the returns, because that's the business and I can control that. And so, big takeaway from all of this book. Most of my investment goes into investing in me, because I'm going to get the highest returns when I invest in myself and in my growth and growing my business. But then again, remember my first lesson, you don't put all your eggs in one basket, even if that basket is yourself and your business. So you always want to put some money aside and make diverse portfolio. And that is, I use the framework from the Intelligent Investor, and I make kind of very, very passive and solid investment in the whole markets. So that's how I think about investment. I hope this was helpful for you. I hope you are smarter with your investment than I was like a few years ago. If I would be smarter and start reading and learning more about how to manage my money and it's at the end of the day, it's an asset. What you do with your money is what's going to bring you forward. I think now I'm much smarter about this and I'm heading in a better direction. If I would do this a few years ago, who knows where I was today, where I could be today. Anyway, have an awesome day. I'll catch you tomorrow.